All right, I know you're probably very eager to dive into the dashboard itself, look at the data, see how we can apply it. And we are working our way up there. And I promise this is the last video before we actually dive into the dashboard itself. But before we do, it's very important to talk about the very fundamental concept of P1 and P2. This is the most important concept of the dashboard and of understanding, for understanding the data that is presented in the dashboard and using it. And even though it is not that difficult of a concept to understand, it is important to cover it thoroughly because it is really going to be the foundation of the time-based statistics. So let's dive into P1 and P2 and what it means and how it's, not how we're going to use it, we're going to get there, but basically what it is. First of all, in the last video, we've determined why time is important. We know that time can help us gain confidence in trades. We know it can help us stay out of trades if we see that a pivot is unlikely to is put in during an unlikely time. We can determine direction. We can find invalidation. We can see take profits, determine if something is scalp, day, swing trade, everything we've discussed in the last video, right? And we have seen also that for that, what the examples we used in the last video, or that I showed you, was to see if a pivot was put in during an important time or not, or a high likelihood time or not, right? So we're trying to determine if pivots are put in during likely time or not. And you might remember that the question was, are there patterns in time delivery as there are in price action? So that's the basic premise of this. The basic premise is we want to determine when highs and lows are statistically most likely to be put in based on historical data. And I want to emphasize that based on historical data. I realize that some of the people, maybe not you, but some of the people go into this. They think this is some kind of like magic indicator or mumbo jumbo or whatever. It is not. It's just hard, factual, statistical data. That's it. It's aggregated statistical data. We're just looking at what happened in the past and we're presenting that data in, a very logical format so we can interpret it easily and we can see, okay, when highs and lows are statistically most likely to be put in. So that's it, right? We want to determine when highs and lows are statistically most likely to be put in because we've seen all the benefits that gives us in the last video. So I'm not going to go into that more. But this helps us determine the likelihood of high or low holding. Because if we know when highs and lows are more likely to be put in, if we then put in a high, then if it's put in during high likelihood time, then we might be more confident that it's going to hold, and a low likelihood time, we might be less confident that it's going to hold. For this, we use the concept of P1 and P2. Those are the concepts we use. And right now, we're going to dive into what those concepts are. And I want to emphasize that this video is purely of what is P1, P2. We're not going to dive into how we apply it. You probably can make a guess when you see it. We're not gonna dive into that yet. That's for later videos. For now, I just want you to understand that is the basic principle of this video. What is P1 and P2, right? What are those concepts? That's all I want you to take away from this video. What is P1? What is P2? So let's dive into the charts to figure that out. So we have determined that if we can find out the most likely times pivots are being put in, then that will help us gain confidence in our trades and do all the other things we talked about, right? We just want to see, are there patterns in when pivots are being put in? Now, what's the best way or the simplest way to look at pivots is to look at the highest point and the lowest point for a given time frame. And I want to emphasize that what I'm about to explain, I'm going to explain it in the daily time frame because I'm going to start explaining the dashboard as well in the daily time frame. But you can apply this concept to multiple time frames. So the essence is there is a highest point and a lowest point in any time frame, right? Could be 4 hour, could be daily, could be weekly, and so on. But for now, we're going to stick to the daily to make the example clear. And once you understand the daily, we're going to go into the daily first, then you will understand all the other time frames as well. But the simplest way of determining pivots is basically looking at when is the lowest point of a certain time frame being put in and when is the highest point of a certain time frame being put in, statistically speaking, based on historical data. And in this case, in the example of the daily time frame, we have when is the daily low most likely to put in and when is the daily high most likely to be put in. So one way of looking at this is basically looking at the, collecting data from when are the daily lows and when are the daily highs most often put in. So you can look at the historical data and see, which times of the day the daily high is put in and which times of the day the daily low is being put in. What I'm doing with P1, P2 is exactly that, but a little twist to it. If you collect data for daily lows and daily highs, it's going to be less actionable because over time, the distribution of when daily highs and daily lows are being put in is going to be pretty even for times. Because if you're in an uptrend, daily low is going to be often put in during the start of the day. And if you're in a downtrend, then the daily high is going to be put in at the start of the day, right? So then you have one data point here for the high and one data point here for the low, and collect enough data points and you will end up, would say that 30 times you put in the low or 33 times you put in the low during, hour 0 and 33 times you put in the high during hour 0. So it's less actionable as in that, well, I know the low can be put in and the high can be put in. So say I run into this and I'm here, I'm like, well, is this going to be it or is this going to be it? I don't know, because both of them have the same probability. So to tackle that, I came up with P1, P2, which is a slight adjustment of this. And that is simply that in this case, the daily low is not the daily low, but the daily P1. And the daily high is not the daily high, but daily P2. P1 stands for pivot 1 and P2 stands for pivot 2. Now this is a little bit of a misleading name because the daily high doesn't have to be a pivot and the daily low doesn't have to be a pivot. For example, this could be a continuation like this, and then this is not actually a pivot, right? Pivot would be more this. That's wrong. Try to get the pencil tool, but you get what I mean. But still, for the concept, I named it like this: daily P1, daily P2. It stands for the highest pivot of the day and the lowest pivot of the day. And daily P1 is simply whichever came first. So if the low was put in before the high, first pivot, second pivot, right? Low was put in first, then the second pivot of the day was the high. Then if the low is before the high, then the low is P1 and the high is P2. If we, for example, delete that and we do this, we have instead a downtrend, then daily P1 was put in, or well, let me put it like this: daily 1 is the high of the day and the daily low is the low of the day. Simply because the daily high was put in before the daily low. And therefore, this is the daily P1 and this is the daily P2. Now, obviously, during the day, this is gonna develop. So say, and we're gonna dive into some real price action in a bit, but say we have this during the day, then we know right now that this is the daily P2 and this is the daily P1. What will happen is that, for example, we have a retracement here. This will still be P2. And then we go here, and at this point, we have taken out the low of the day, so we have a different one. And then this is the daily P2. So very simply put, P1, P2 is just the highest point of the day or the lowest point of the day. And again, it could be different time frames, but for the sake of argument, highest point of the day or the lowest point of the day. P1, it's whichever came first. Whichever came first, right? And the very basic reason why we're using this is because it is more actionable. It is more actionable. And you'll see when you start using the dashboard why, but you will see that if you use P1, P2, there's way more patterns in the data than if you just use highs and lows. You don't have that problem where I just said that you had 33 occasions at the high and 33 occasions at the low. You don't have that because whichever it is, high and low, you know, it's going to be at the start of the day. So there is a pivot at the start of the day, which is what you want to know. And there are ways to determine, you know, is it going to be the high or the low? We're going to get into that all in the dashboard. It's not important for now. But the gist of it is this is more actionable. Looking at highs and lows in this way, I have found it to be more actionable and the data supports that. So let's look at a couple of practical examples just to make it more clear, or you know, have some real life examples what it is. Here we have daily opens until I actually don't have right here the daily opens, right? This is and it's actually good to mention, I almost forgot, that the daily opens are calculated on UTC plus 0 time zone. Everything we're going to talk about is calculated in UTC plus 0 time zone, simply because the daily open for everyone, for everyone who looks at the daily candle, no matter what time frame you're in, it opens at midnight UTC plus 0 time zone, right? So this is always going to be the same for everyone. Now, if we have a trading day here, so this is one daily candle in 1 hour candles, right? Then let's look at where P1, P2 is. Well, we can see here is the high of the day, and here is the low of the day. It's very simple. Which one came first? It's the high, so the high is daily P1. Daily P1 and daily P2. Right, very simple. And again, it's not important yet how, what, or how we're going to apply it, at least just for now. Let's understand what it is. Here, the next day, we look at the low was put in here and the high was put in here. So we know that in this case, the low was first. So the low is the daily P1 and the high is the daily P2. We can keep doing this. We see that here the high was put in and the low was put in second, which makes the high the daily P1 and the low the daily P2. Here, now you have to watch closely here, the high was put in first and then the low right here, which means that the high was put in first, so the high is the daily P1 and the low is the daily P2. Let's take one more example. The low was put in first here and then the high, which makes the low the daily P1 and the high the daily P2 right here. Here, the low was put in first as well and the high second. So the low, daily P1, high, daily P2, close call right here. And here it was the high first and the low second, as it seems. But you understand the idea, right? It is P1 is whichever is either the high or low of the day, whichever came first. So there's one more basic principle I want to explain here, and this is going to get a lot more obvious during the later videos where we go over practical examples. But I want you to understand that the daily P1 is either going to be the daily P1, but it can never become the daily P2, right? This was put in first during the day, so we can never, I don't know, go back in time and for whatever reason make it the second pivot of the day. It's simply impossible. This one is always going to be P1, or it's going to get taken out and then it's nothing. But it's not going to be the second pivot of the day. Also not when it's here. Just very simple. P1 will never be P2. Then we look at P2. Is that the same for P2? And the answer is no. P2 can, well, either be taken out and then we have a new P2, or it cannot get taken out and we do like this and then this is how it will stay. Or we can go like this And what happens, right? And this is important to understand. And again, we're going to see plenty of examples, but it's important to understand that what happens then is that the high takes out the low. So this is no longer anything, right? It's neither P1 or P2 because it's no longer the high or low of the day. This is the high of the day and this is the low of the day. Which one was put in first? This one was put in first. So that means that the high was P2. It was the second pivot of the day because we put it in after the low, which was the lowest pivot of the day. And it no longer is so because we changed it, right? Now the second pivot of the day is this. And the first pivot of the day is this. This is what we call a P1, P2 flip. How exactly we're going to use this, we're going to see in later videos. It's really not important right now, but I just want you to understand the basic concept that P1 can never become P2, but P2 can become P1, right? The first pivot of the day can never become the second pivot of the day, but the second pivot of the day can become the first pivot of the day if we take the first pivot out. So again, we have this, daily P2, daily P1, but we took out the low. And then because of that, this is now the low is the second pivot of the day and the high is the first pivot of the day. The P1, P2 flip. Let's look at a quick example in real life. So we have what we just looked at. And I see, yeah, for example, here, what we have right there is, got it right here, get it to the 1 hour. So what we have at this point in time is that P1 is here and P2 is here because the daily low is P1 because it was put in before the daily high. Now, if we go up in price action, we see that already here, well, here for sure, the high took out the low. So what happened now is that, or the low took out, the low was taken out, sorry. The low was taken out. So what happens is that this is no longer the highest or the lowest point of the day. So it's not P1 nor P2. This is the high today and this is the low today. The low is now after the high. So what happened is that the low is now P2 and the high, first P1, or first P2, sorry. First, the second pivot of the day is now the first pivot of the day. Again, not important to understand exactly how we're going to use that information for now, just to understand that it is so. And as a final remark, we have an indicator for this. You don't need to actually draw it out yourself like I was doing in this example. So we have the P1, P2 helper. It is right here. You can find it in the Discord. Favorites. Minoma Analytics P1, P2 helper. And what it does, I can just delete this, and delete this, is that you can see it will draw out for me the daily P1 and the daily P2. It will show me the daily open and the daily close. If I go to the lower time frames, it will show me the same thing on the 4 hour. So this is now the 4 hour P1, but no need to bother yourself with the 4 hour time frame yet. We'll get into that into later videos, but I just drew everything manually for the sake of explanation, but you won't have to. You can just use this indicator and it will draw out the pivots for you, but it's important to understand the concepts, and this way at least you understand the concept. But for drawing out the pivot itself, the indicator will do it for you. It will actually tell you the hour in UTC plus 0. Again, everything is in UTC plus 0. And here also the same thing, the hour the high was printed in. And we'll see later why this is valuable. So to summarize everything, P1 stands for pivot 1 and P2 stands for pivot 2 are the high and low for a given time frame. If the high was put in before the low is P1 and the low P2. If the low was put in before the low is P1 and the high P2. P1 can never become P2. P2 can become P1. P1 and P2 is more actionable than highs and lows, which is why we use it over just looking at highs and lows. And we're gonna see that. So this is the basic principle of P1 and P2, the basic concept, very important to understand. And with that out of the way, with that clear, Again, use the indicator. It's just an explanation of what it is, but you can use the indicator to draw it out for you. But with this explanation out of the way, we can actually start diving into the dashboard. So let's move on to the next video where we will dive into it.